Warren Buffett's investing rules suck. Value investor adorn Warren Buffett for various good reasons. First, his investment track record is unrivaled by any other investor in the last 100 years. Understandably, value investors have attempted to imitate Buffett's investing strategy to capture a sliver of his returns. Unfortunately, investors' attempts to imitate Warren Buffett have resulted in a less than ideal strategy. There are various reasons for the same, and today we will discuss some of them in our video. If you love talking about shares, investment strategies, and more financial knowledge, then subscribe to our channel for more such videos. Here we begin. Why do Buffett's investing rules sometimes suck? He is a great investor and his investing tips are beyond imaginations. They help each individual greatly, and his generosity or communication style as a financial teacher makes him different. But his contemporary investment style is not for everyone, as a simple person cannot easily earn profit following his investing tips. Blindly following his strategies and reading some books would not make you like him. So, what are the reasons? Firstly, you don't have his stock picking knowledge. Warren Buffett is an expert at analyzing companies and picking stocks. However, many ordinary investors need to gain knowledge and skill. Indeed, it is for this reason that Buffett has frequently recommended that the average investor invests in index funds. Index funds are funds that are passively managed and track various benchmarks. An S&P 500 index fund, for example, will seek to match the performance of the S&P 500 index. The advantage of stockpiling index funds is that it removes much guesswork from investing. And index funds provide instant diversifications, which is essential in any portfolio if you invest in an S&P 500 index fund. You might have different goals. Warren Buffett's goal is to give away his enormous fortune, and he's already halfway there. But most of us aren't looking to give away our money. Rather, we require our funds to cover our retirement expenses. This isn't to say you plan to spend your entire nest egg in your lifetime. You should leave some money to your children, for example. However, you are unlikely to leave your entire estate to a collection of charities. As a result, you'll need to approach investing differently than Buffett. You can't afford a similar level of risk. Warren Buffett is wealthy. As a result, he can afford to lose a fair share if that situation arises. As a result, despite the risks, Buffett can continue to invest a large portions of his wealth in stocks. As we age, it's a good idea to diversify away from stocks and into safer investments such as bonds. This is different from seniors selling all of their stocks, but they should reduce their holdings. Buffett, who is 90 years old, is exempt from this rule, so it would barely affect his wealth or lifestyle if he lost $1 million in the stock market overnight. But because the rest of us don't have Buffett's wealth, we can take on the same level of risk. His way is different. While Warren Buffett still believes in Benjamin Graham's fundamental philosophy, he employs a very different investment strategy than Benjamin Graham advocated for years. Warren Buffett's investment strategy has evolved significantly since the 1950s. Rather than looking for classic Benjamin Graham value stocks, as he did when he ran his investment partnership, Warren Buffett has shifted his focus to finding good companies at reasonable prices. His stock selection process has become very simple, with only 4 filters. Warren Buffett also holds his investments for an unusually long period, far longer than most other long-term Wall Street investors. While some professional managers discuss holding stocks for months or years, Warren Buffett discusses holding his investment for decades or his entire life. The popularity of Warren Buffett has drawn many new investors to the value investing philosophy. These investors are typically introduced to value investing through Warren Buffett's contemporary investment style. Typically, this entails purchasing medium or large cap companies that have been in the spotlight for years, with market capitalizations well above $1 billion. Unfortunately, this strategy is far from ideal and may even be hazardous. Should skilled investors follow Warren Buffett's current investment style? Maybe. Warren Buffett's investment style suits him, so other investors would benefit from adopting his style, but that investors is very unlikely to be you. Why? Warren Buffett abandoned Benjamin Graham's investment style because his portfolio had grown far too large to take advantage of classic Benjamin Graham investment opportunity. During the 1950s and 1960s, Warren Buffett used Benjamin Graham's investment strategy with great success. Buffett earned returns of over 20% throughout his career. But consider how well he did use Benjamin Graham's investment strategy. Since leaving Benjamin Graham's investment strategy and growing his managed funds, his returns have decreased significantly. But of course, you'll point out that the increased amount of money he was managing meant that his return would inevitably suffer. And you'd be correct. To return to the original question, whether or not you are a skilled investor is only one factor to consider when deciding whether or not to adopt Buffett's modern investment style. Another major consideration is the amount of capital you have to invest. It's fine if you don't. However, people eventually want to spend much less time and effort managing their own money. There's nothing wrong with that, and an index fund may be a better option. Let us know your views about how this fails, and subscribe to our channel for more such videos.